Wonderful to start Mondays with you. Thanks for being with us. Any cause for concern whatsoever around this Powell pivot? Because certainly the overwhelming majority of people on this programme this morning don't have much concern.
No, I don't have much concern, but I would say, and I know you've all been talking about it throughout the course of the morning, be careful what you wish for if you're hoping for an aggressive cutting cycle on the part of the Fed. Because if you look at, and there's a long history in terms of years, but there's only 14 full Fed cycles over history. That's a pretty small sample size, and you have a really wide range of performance in terms of what the market has done in the aftermath of the initial cut. But where things are a bit clearer is if you contrast fast cutting cycles with slow cutting cycles. And the maximum drawdown is twice as large within a year following the initial cut in fast cutting cycles versus slow cutting cycles. So you actually want a Fed that is eyeing the escalator down, not the elevator down. And I think that gets lost in some of this debate.
We've heard people say, I'm sure you have as well, Liz, that the Fed puts back, Lizanne. The Fed's put back and everything's going to be OK, no matter how bad the data might be. Lisa mentioned this, Lizanne. I think we need to build on it a little bit more as well. How the market would respond to bad data. We've been told good news is good news and bad news is bad news. Do you think even then, after what we heard from the chairman on Friday, bad news still really is bad news?
Well, particularly if it's really bad news. If we were to see a significant weakening from what we've already seen within the labor market, yes, you'd get that reaction function on the part of the Fed, but I'm not sure risk assets would have a sustainable rally associated with that. So I think that's the calculus at this point, is the level of weaker than expected data and what it generates in terms of expectations for the Fed.